She is the CEO and co-founder of Cartica Management, a firm specializing in emerging markets and, as you pointed out, activism that has $3 billion in assets under management. Teresa, nice to see you.
Thank you, Eric. It's lovely to be here.
Bruce Richards of Marathon Asset Management was sitting in that seat earlier today, and he told me the sell-off we're seeing right now, 300 points on the Dow, 1.5%, as measured by the Dow Industrials or the S&P 500, marks the beginning of the end of the Trump trade. If, in fact, he's right. Well, let me ask you that question. Is he right?
Well, in the emerging markets, we've seen the Trump trade reverse itself really throughout 2017. We've had more than 4 months of straight inflows of foreign investment into emerging markets, reversing the November-December trade
the big sell-off, yes.
Where's a big sell-off and EMs going back to the U.S. So we've already seen that reverse.
So if, in fact, again, Bruce is right and the Trump trade is ending, what implications are there for emerging markets? Are they only good in as much as capital now tied up in, if you will, U.S. assets needs to find a new home?
You know, I would take that in 2 parts. One part is that the U.S. agenda, if it's tax reform, rationalization of taxes, some ease of doing business, issues on getting regulation down, that's all positive for emerging markets. And on the other side, the emerging markets themselves, I believe, are at an inflection point starting in the summer of 2016 that's really only continuing now. And to look at the prices now, I would say that train still is in the station. It hasn't even left the station.
To what degree is that inflection point, the shift in paradigm, influenced or not by what goes on here, U.S. policymaking?
You know, I think this time, not too much, really. We've seen a little bit of a decoupling between the trade relations, between the importance of trade, I should say, between the EMs and the U.S. The EMs themselves really started to slip from 2013 to 2016. We saw then that turnaround last summer when sales were improving, margin compression, which we had seen, was reversing, and earnings per share growth were increasing, as were positive revisions. So coming in now to 2017, we're looking at EPS growth of 19%. So that's the best in the world. So we have a very good setup.
What about protectionism and what appears to be China's effort to fill the vacuum that the Trump administration might create and become the new arbiter for global trade flows?
So 2 separate questions there, I think. So on the trade
but related
front,
questions.
Absolutely, because the whole world, sadly enough, is interrelated. So on the trade side, first of all, Mexico was probably the country that was the single most hurt in the so-called Trump trade. Their Mexican peso took it on the chin. The lowest point was at the inauguration of Donald Trump in January. It's now back to where it was in October. And everyone agrees now, all 3 countries, that we need to refine NAFTA. It needs to be revised. But the temperatures come down from 104 fever down to homeostasis almost, like maybe 99 degrees, right? And so that I think has been diffused. And now we have a 2-page trade agreement with China, very narrow. Doesn't say much, it's only 2 pages, but that is not very threatening because of how narrow it is. That's separate from whether China takes the lead in trade, and I think that's already happened. China is everybody's biggest trading partner already, and you know, I think that will continue, as will the intermediate goods going to China and then being finished in China and exported elsewhere. So the complex supply chains, they will be with us.
You're very bullish on India.
Yes.
Why?
Well, you know, Eric, I think that there are 2 investment themes in India that I really haven't seen written about really anywhere, and I think are extremely important, if you don't mind. One is formalization and the other is financialization. So,
formalization
Yeah. So,
being the formalization of the informal economy.
right. So India, like a lot of countries, has a lot of informal, they call unorganized economy. It's manufacturers, distributors, retail. And now that transactions are trackable and therefore taxable, the tax net is coming in on these unorganized companies that don't play by the rules. They don't pay their taxes, they don't pay by the environmental rules. And then with the goods and services tax coming this summer, again, tax net's going to tighten. This leaves opportunity for the listed companies that follow the rules, that pay their taxes.
To take market share.
To take market share. Like Page Industries, for example, makes jockey underwear, right? Everyone knows jockey underwear. 60% of the underwear sold in India is made by this informal sector, and it's saggy, baggy underwear.
And a lot of that is going to go away.
It's going to go away,
What
and
about
Page can come in.
financialization? What's that all about?
Financialization, I think, is really important. First of all, only less than 1% of GDP is represented in the stock exchange. So it's tiny. You've got 98% of all the money has come out of the mattresses, into the banks. It's all there. And Erik, 30% of Indians are millennials. They're between the ages of 18 and 35. They control 70% of household income. These are the guys that are in their prime savings years. They're putting money in mutual funds, pension funds, insurance companies, and the government has allowed those institutions to put more in equity. So these are the guys that are now starting to go into equity, and they're going to move the domestic market forward.
The Indian stock market is up 15% year to date?
Yep, it's at its all-time high.
But you make it sound as though, at least by your point of view, still undervalued.
More to run. There's more to run in the Indian stock exchange. So when you look at the price earnings to growth ratio, you still see the Indian stock market at about 1, and the U.S. got it getting close to 2. So it's almost twice as expensive for the earnings you get.
What about emerging markets as a whole? How much more room is there to run there?
A lot. That's even better. Their price earnings to growth ratio is 0.7. So U.S. equities are 2.5 times more expensive for the earnings you get for the emerging markets as a whole. And is the risk 2.5 times as large? I mean, is U.S. not risky? I don't know. I haven't seen Bloomberg for the last hour or so, so I don't know. Maybe something less risky has happened in the last hour.